Pensions can be confusing at the best of times, and it can be hard to understand what your options are when you retire, as well as trying to comprehend how much income your pension may be able to generate. With that in mind, this video is going to try and answer how much income you might be able to take from a £300,000 pension from both Flexi Access Drawdown or an annuity. Stick around to the end, as I'm going to cover several retirement ages for those of you who may be thinking of retiring earlier. Turning to drawdown, let's see what income you might be able to take if you opt for a flexible income through drawdown. With drawdown, you can take as much or as little income as you like, and the flexibility can allow you to take perhaps more income during your active years whilst you have your health, and maybe reducing the income in your later years as your spending naturally declines, or maybe another source of income kicks in, such as a final salary pension or your state pension, for example. As you can take as much income as you like, it's hard to say exactly how much income you might be able to take with drawdown. But before you switch off, and I've mentioned this in some of my other videos, one of the best ways to give you a rough and ready idea is to calculate what income you could take each year that would extinguish the drawdown pot at a certain age. To make this realistic, one option is to set it so the pot is extinguished at a realistic and conservative age for life expectancy. With that in mind, let's make a few assumptions, and we're going to use our example based on Mary, and we'll assume that she has a life expectancy of age 92. So we'll set it so that the drawdown funds pays out the same amount each year so that the pot is extinguished at this age. I know, the whole point of drawdown is the flexibility and the ability to change your income, and virtually nobody is going to take the same exact amount of drawdown income each and every year. But I think for the purposes of looking at the sustainability of the income, this is one of the best methods. The income that is taken from the outset, we're going to increase that by inflation so that it maintains its purchasing power. For inflation, we'll assume 3% a year, and we'll assume the investment returns are 4%, which will be net of all fees. We'll base it on someone who retires at age 55, 60 and 65. For someone looking to retire at age 65, this is a potential retirement term of 27 years. So you could potentially take a starting income of £12,619 that increases with inflation for the pot to be completely extinguished at age 92. By age 74, the pension would still be worth over 269k that your beneficiaries could potentially inherit if you croaked it, and that would be tax-free. If we assume Mary was entitled to the full state pension of £11,492 per year, a year later at age 66, this is a retirement income of more than £24,000 without even accounting for a spouse or partner's retirement income. Looking at the Retirement Living Standards Survey, which I've harped on about in past videos, which is £14,400 for a minimum standard of living in retirement and £31,300 for a moderate style of retirement, then a 300k pension pot, along with the state pension, may give you a half-decent retirement. For others, this will be more than enough, and argue that these figures are way inflated, and that's why they say variety is the spice of life. With the average pension pot for a 55 to 65 year old at around £107,000, you may be spitting your coffee out at the thought of building up a 300k pension pot with the pressures on the cost of living and all the rest of it. How hard, Alex, is it for somebody to try and build up a 300k pension? For the younger audience, auto-enrolment should certainly help things. If we assume somebody entered the workforce at age 25, is employed and earns 30k a year, the minimum auto-enrolment pension contributions would be £158 per month. If we then assume these contributions increase by inflation, as their salary hopefully increases or matches price inflation, this person contributed this amount for 40 years, which would take them up to age 65, and the underlying pension grew by 4% a year, the pension could be worth over 302k. You may be thinking, hang on Alex, you haven't taken inflation into account. £1 today and compared to 30 odd years time is going to be worth a lot less than it is now. However, with the growth rate, I've assumed that this person invests in global stocks which grow at a reasonable forecast of 7% a year over this time. We're going to knock off 3% for inflation and fees, leaving us with that net return of 4%, which should mean the numbers quoted earlier are actually in today's money. Even if you felt 7% was too high, and if we use a more conservative gross growth rate of 6% or 3% net, the final pension would still be worth over 246k in today's money. Not bad. Right, let's turn to somebody who perhaps retires earlier at age 60. Perhaps they've had enough of the rat race. That's a retirement term that is 5 years longer at 32 years. It's reasonable to think that as the pension will be in drawdown or decumulation for longer, the starting income is going to be less than somebody who retires at age 65. Or put another way, you're going to have to perhaps save more to enjoy a higher income compared to somebody who retires later. This could provide a starting income of £10,846 per year. Along with a full state pension, this could potentially be a combined income of over £22,000 in today's money. Finally, let's turn to somebody who perhaps calls it a day at age 55. If we assume a life expectancy again of age 92 and the pension pot runs out at this age, this is a retirement of 37 years in which the pension fund has to support you, and for some, this would mean you would perhaps be retired for longer than you worked.
Groovy, baby!
As this places more of a strain on the pension fund, quite naturally, this may mean you will have to potentially take less income, again, compared to the previous examples, or if you want to rely on investment returns being as strong as they have been in the past, this could generate a starting income of £9,559 per year that increases with inflation. One thing to be aware of is that to qualify for the full state pension, you need 35 qualifying years of paying the necessary national insurance contributions. If you start to work at 21, this would give you 34 years and just shy of the full amount. For the purposes of this example, and to make life easier for me, we're going to just assume that the full state pension is paid. So this will be a combined income of £21,051. So that's a lot of numbers. Let's see a summary of what the potential income a 300k pension could generate using the method described earlier. Although you can't rely on these numbers absolutely, it does show you how the longer your retirement, and this could be either retiring early or the more unknown and morbid opposite end of the spectrum, living longer, you may have to spend less money. Another popular option is to use an arbitrary rule of thumb such as the 4% rule. This involves taking 4% of the starting pension each year and adjusting it upwards each year by inflation. However, you're going to see many commentators online or a quick Google search suggesting that 3% is more appropriate, whereas others would say that you're going to be fine with a withdrawal rate of 5%, which actually included the architect of the 4% rule saying so himself. However, it must be stressed that the evidence for these withdrawal rates is all backwards looking and based on historical returns. With the global economy and world facing serious headwinds, it could make these figures obsolete and future returns could be much worse, with no guarantee using a withdrawal rate will prevent you depleting or running out of money within your drawdown pot. On that cheery note, let's look at some of the risks of drawdown in practice and how it can go wrong. In this example, we're going to take an example from earlier, but we're going to tweak some of the assumptions. And we're going to base this on someone who retires at age 60. We're going to assume net investment returns are much worse than expected at 2% a year, and Mary withdraws 7% of the starting pension amount each year, which from the outset is £21,000, which, if you remember, increases by inflation. In this scenario, the pension would run out at age 74. This could potentially leave you with a very uncertain future for your remaining years, particularly if you've been accustomed to the good life. For annuities, we're going to focus on lifetime annuities. With an annuity, you essentially swap your pension fund in return for a guaranteed income that is paid for life. Once you die, the annuity usually dies with you. It's possible, though, to add inflation protection and also a survivor's pension so that the income maintains its purchasing power and can provide a pension for your loved ones, but these additional frills can reduce the starting income. As the income is guaranteed, unlike drawdown, there is no guarantee of the pension depleting as the annuity income is paid for life, as we said earlier. Annuities fell out of favour after the pension freedoms were introduced in 2015 and because of the ultra-low interest environment that existed right up until 2021 or so. You can see how the potential income from annuities has increased dramatically as interest rates have risen in recent years, to combat inflation. The amount of annuity you get will depend on many factors such as how old you are. As the older you are, the better the rate tends to be, as the insurance company statistically will have to pay you the income for a shorter period of time. Your health's important. If you've got any health conditions, you may be entitled to an impaired annuity, which can lead to a higher annuity rate. If you add on any inflation protection or survivor's pension, this will usually reduce the starting income. The annuity rates will be different from insurance company to insurance company. To illustrate how the different options that you choose with an annuity can affect the income, we're going to base it on two examples. The first annuity, this will be on a single life basis with inflation protection. For the second option, we're going to include a 50% survivor pension that increases with inflation and has a 5-year guarantee, so that it pays the full amount for 5 years, even if you die. You can see how the extra frills of an annuity can reduce the initial amount of income. As with the drawdown example, we will give examples of an annuity purchased at age 55, 60 and 65 to show you how the age at which you retire can affect the starting income. Both assume this is for someone in good health. It is worth mentioning that annuity rates change all the time, as we could see in the graph earlier. As you can see on the screen now, the age at which you retire or opt to take an annuity really does affect the level of annuity income available that you may be able to get with your pension. If you retire at age 55 compared to someone who retires at age 65, your annuity income, all else being equal, could be as lower by as much as 30%. Knowing how much income you can take from your pension is important, but if you are considering drawdown, watch this video which looks at 3 things that you can do to prevent a stock market crash from ruining your retirement.